So for today's assignment, what we were tasked with doing is evaluating Starbucks investment into a flagship roastery. So the first thing that we know is or our question is, should Starbucks accept the flagship roastery requiring 1,200 million upfront, operating for 10 years, and how do we use the WACC of 8.5%? The key concepts that we need are our incremental cash flows, the depreciation tax shield, terminal value, and WC recovery, working capital recovery, taxes is 25% corporate rate. And then we need to know our discounting, which is 8.5%, the weighted average cost of capital. And then we need to know our payback, simple undiscounted payback and discounted payback. And that shows our profitability index and our present value of future cash flows. So for our assumption, our index capital is 12 million at year zero, and straight line depreciation for 10 years. Our working capital is 500,000 at year zero and recovered at year 10. Revenues, year one is 8 million. Years 2 to 5 is 11 million. Years 6 to 10 is 9 million. Cost of goods is 40% of the revenue. Our labor is 25 million per year fixed. Our rent and utilities are 80,000 per year fixed. Our marketing is 300,000 in year one, 100,000 from years 2 to 10. Our taxes are 25% of the corporate rate tax. Terminal value is 3 million at the end of year 10, and that's our salvage value. We're going for 10 years, and our WACC is 8.5% base, and it has plus or minus 2% for sensitivity. And then our strategic framing is that this roastery is both a financial investment and a strategic brand play. The financial metric will tell us whether it adds to shareholder value, and strategic items may justify accepting the project, even if the net present value, even with marginal net present value, if it unlocks brand and opportunities not captured in the short run cash flows. For our represent stage, we're going to construct it year by year with the incremental cash flows. And then we're going to compute the present value using WACC and metrics. So the net present value, sum of present value. IRR is just through the standard algorithm, simple payback, discounted, undiscounted, cumulative, and positive, or cash flow turning positive. Discounted is cumulative present value turning positive, and the profitability index is the present value of future cash flows divided by the initial absolute outflow. The sensitivity tests are the revenue scaled by minus 20%, negative 20%, so all revenues times 0.8. And the WACC sensitivity test is with 6.5% and 10.5% using the original profile. Visualizations are yearly net cash flows as a bar graph, and then the present value across scenarios as a bar graph. And then our deliverables are the Python script and the CSV flow metric and the instruction for the script walkthrough. As we have here, these are our formulas to calculate all those that we just went over. You can take a look at those, but they're present in the code as well. So here we have the implement step for our code. And we'll just run this. And so now we're finished. So it's finished running, and we'll go over the results in a second. But just for the notes, this is our implement step, and this script builds a transparent year 0 to year 10 cash flow model, calculates net present value, IRR, paybacks, and profitability index, and it runs a sensitivity test with revenues decreased by 20% and the WACC increased and decreased by 2%. It produces charts and saves the outposts. And this is what I had AI create for me. And so we can go over each of the functions in a little bit, but we'll get straight to the output for this. And so these are calculated in the millions. So for year zero, our cash flows is negative 12.5 million. For year one, it's 1.2 million. Year two, 270 million. Year 2 to year 5 is 270 million. Year 6 to year 8, 1.8 million, or 2.7 million. Year 6 to year 8, 1.8 million. In year 10, it's 5.3 million. And the present value of these flows from for year 1 is 1.1 million. For year 2, it's 1.29 million. Year 3, 2.211 million. Year 4, 1.95 million. Year 8, 1.8 million. Or year 5, 1.8 billion. Year 6, 1.1 million. Year 7, 1.02 million. Year 8, 0.94 million. Year 9, 0.86 million. And year 10, 2.34 million. So our performance index is our base WAC for our base WAC. The net present value is 3.02 million. The IRR is negative 0.117. The simple payback is 5.28 million, and the discounted payback is 8.21 million. For the negative revenues, our net present value is, or no. Yeah, for the negative revenues, our net present value is negative 3.16 million, and the IRR is negative 0.031. Discount simple payback 9.39 million. Discounted payback wasn't available. WAC NPV 4.64, IRR 1.7, 5.28, 7.27, and then for the increased WAC or decreased, that was decreased WAC, and for increased WAC, NPV is 1.63. IRR is the same as the other ones. Um, Simple payback is the same as the other ones, and discounted payback is different at 9.17. And what that shows is that for the discounted payback, it actually matters what our WAC is, but for the rest of them, it just calculates it. For the rest of them, aside from net present value, it calculates it aside from that. So net present value and the discounted payback have a good correlation, or are correlated in some way. And so our profitability indexes are right here. And then so this is our net cash flows as a bar chart. You can just take a look at that. And then this is the sensitivity for revenues, or this is the net present value and revenue sensitivity. Net present value sensitivity for revenue and WAC changes. My bad. And so now that we've gone over the code, we can go back into our validate step. So the checks I performed were the accounting cash flow, and the oh no, these are the checks we performed, and these are just the numbers. And so these are like conservative estimates, and they're verified in the CSVs. Um, the sanity checks were right here. And the cross scenario is like when revenue is scaled, all the dependent entries change proportionally and the results remain consistent. But the possible limitations, the tax model assumes no NOL, carrybacks or carry forwards. So it's conservative for the tax shields, and there may have been losses elsewhere. The IRR return in it not available, as the numerical algorithm used had trouble finding the actual root. And since NPV is positive, IRR should be greater than the WAC, but the AI recommended computing IRR via NumPy Financial. And so that's one thing I could have done. But NPV is the preferred decision metric for professional standards. There's no escalation or inflation of costs and revenues model. All the numbers are as provided. And so I could assume real and nominal or assumed growth, but I didn't. And then the strategic benefits beyond cash flow is the brand halo and marketing are not captured here. And that's part of the next section. So the validation conclusion is that internal accounting mathematics checks passed, and the scenario outputs are consistent with and responsive to parameter changes. The base NPV is net present value is positive, and the sensitivity shows the revenue risk as a dominant factor. for the Evolve, we have applications for other analyses. And the first one we did was project portfolio ranking. So the profitability index allows ranking against other projects with a project index of 1.24. The roastery is an attractive relative to projects with or lower profitability indexes or negative net present values, but compared to constrained capital budgets, but compare on constrained capital budgets, which means that we know that the budget for this is 12 million. Like that's what we need for it. But if there's a project that has a similar profitability index with a much lower budget, like much lower inputs, we should go for that project. And for our option value, it's a flagship branding project. So the thing that we were talking about last time up here with the brand halo and marketing value, it's a flagship project. It's the first one that Starbucks is doing, and it can have like a very positive impact if it goes well. And so that's what that's the intangible benefits that they're talking about, like customer value, lifetime value uplifting, brand equity, and higher store sales elsewhere. Just people knowing that Starbucks is doing this and that Starbucks is making its own coffee could be a very good selling point, especially if they do it ethically, because ethical consumption is a big thing now. So if they're using the beans farmed ethically or getting it from their selves, or their want to say it's organic, they could do a bunch of marketing through this value option, or through this marketing play that actually increases the stability of the brand in people's minds. And so the optional strategic benefits might justify accepting an otherwise marginal project. So like I said, the outside benefits aside from money might justify this project, and that though those outside benefits will bring more money in the future. The real options is, given potential uncertain revenues, Starbucks could stage investments. So that just means instead of dropping that 12 million in there, they could go say 3 million here, 3 million here to get like a very low effort, not low effort, low investment, low involvement sort of preview of what this project would be like, not making their own, not completely making their own roastery, but sort of investing in somebody else's roastery, buying a part of that roastery and running it and seeing how that works and how they can market that decision. And then maybe going up to 9 million to get that, to kind of scale it further. And after that, going to the full 12 million and getting their full return on investment from the brand politics that they want to use for it. Um, like it says, incorporate expansion options if early performance is strong, reduce downside risk. So sort of just incremental steps like that 3 million, 6 million, 12 million, or whatever it takes. And then so the management, the sensitivity suggests prioritizing mitigation on top line risk. So we knew that instead of like the revenue is a big risk in this, it's a marginal project. But if you market it well enough, the revenue doesn't become the main goal of it, like you said before. So marginalizing that top line risk could include pre-launching marketing set partnerships or reserve capacity for special events to increase utilization. So like making a special coffee brand for Christmas or whatever, making a special bean roast for Christmas, or sort of like we said before with that incremental investment, investing in somebody else's, owning a part of somebody else's roastery. So that partnership aspect of it and those pre-launch marketing commitments, sort of the ethical roasting and all of that. And then for our last one, it's capital structure interactions. So it assumes the project is financed with average company financing. So if Starbucks should do this differently, they could finance with cheaper debt or adjust the discount rate accordingly. So basically, getting a better loan. And these are some of the options that the AI suggested as a better, or not a better. a another way to sort of visualize these evolved scenarios. And so for the reflect, the investment decision making and financial recommendation. Um, so the best case NPV or base case NPV is positive 3.2 million, 3.02 million using the WAC. The project shows sensitivity to revenue, a 20% decline converts to negative NP net present value. So that revenue risk is very, very significant. Even just a 20% decline. Well, 20% is pretty significant when you're moving at 12 million. But that 20% decline, that 2/10 decline, can make the project go negative more than you would have made even if it was positive. But the non-financial strategic factors are are one of the main benefits of this. That flagship grocery bringing brand experience benefits like the marketing and the product development and PR, which are not in those cash flows, and they could add to cash flows after as a sort of as a brand loyalty argument. So the recommended case is accept on two conditions. Proceed with the given base case NPV using the company's given WAC, and the uh, project appears to create shareholder value under those assumptions. And then the second condition is to manage top line risk before the final approval. Require the revenue mitigation, sort of the pre-opening commitments, the budget marketing flexibility, and then the incremental investments because the 20 shortfall because of this shortfall that 20% revenue change creates. And so the rationale is pretty simple: positive NPV and project what is it? Profitability index. Oh yeah, positive NP net present value and profitability index above one, combined with the strategic branding benefits, justify this acceptance. Like we said before, all the benefits outside of the money are what really make this such a good investment. Thank you. Hope you learned something about NPV and uh, outs- and the benefits of financial investments outside of the financial returns.